Good morning. Welcome to the Brew. Beautiful Monday morning, starting a new week. I'm your host, Lex. We are continuing with Greek week. We didn't get it finished last week, and we're going to land on row today. So let's be ready for the seatbelts. This is going to be a tricky one, but we're going to do it. Get to the opening bell right now. Molly, you're back.
Good morning, Lex. How was your weekend?
Oh, unbelievable. You saw that I had my Barbie outfit on this weekend.
You did. And you had your Nantucket Nectars. That was very chic, very impressive.
Yeah, you know, I did not go see that movie, by the way. It's just so we're clear. I did pretty much have that outfit on. I don't know. How was your weekend? Good?
It was great. It was just relaxing. Yeah. I think I needed a good relaxing weekend, so it was good.
Me too. I'm noticing that our show on Mondays, I'm a little beat up.
Right.
I got to be honest. I'm a little beat up on Monday morning.
Oh yeah. So, we should do P90X before our show.
Yeah, we need to do something. I'm like, dragging. Of course, I didn't prepare for anything over the weekend, right?
You don't need to because you're an expert. That's that point.
I got that. So we are going to talk about row today. This guy.
Look at that guy. Look at that guy.
So here's our little guy rowing in the boat. So row is RHO, right? Another Greek. It's probably known as the I don't know. It's the ugly stepchild of Greeks in terms of, you know, analyzing an options portfolio. So I guarantee you in the retail world, not many people pay attention to this. Do you know what this is? Do you know what this is, Mark? Because you do all the research. You're right on top of what row
Let's see.
Right?
Let's see if I know what it is. It is
this just in.
Measure of sensitivity of an option price to changes in the risk-free interest rate.
Right.
That's what it is.
Why is that important? You know, again, let's go back to the market making side. Market makers are reactive. They have positions. They have to respond to bids and offers, and then when they do, and they get trades, these options go into inventory, right? And market makers don't have a choice of which months they're going to trade. They have to make markets in everything. So you can have, you know, inventory, option inventory in front months, mid months, far months, you name it. Row, as you said, let me change the slide if I can. Hang on a second. We got so many computers here. You said it right. So it's the rate at which the price of a derivative changes relative to the change in the risk-free interest rate. Okay. So when interest rates change, so do calls and puts, right? And that you'd be surprised, they change not in proportion to one another. So they're opposite, calls and puts. And we'll show an example here in a second.
Okay.
It also, for market makers, row measures the risk in their portfolio. So every option has a value, a row value. Okay, and we'll get in the next slide. We'll see some of that. But every option has a row value. So if you're a market maker and you have long some calls, short some calls, long some puts, short some puts, and all over the board, what their computer systems do is they take all those values, they add them up, and they give you one number for row. Okay, and that number can be a very big number. So let's say your row is positive 1,000 as a market maker from all of your inventory, longs and shorts netted out is 1,000 positive. If interest rates go up 1%, again, that's the metric we use in the industry, rising and falling by 1%. So if interest rates go from 4% to 5%, okay, that row tells you as a trader how much you're going to make or lose in your inventory. So if I'm, if I'm up along a 1,000 row, interest rates go up 1%. I'm going to make $1,000 in my portfolio. Simple enough.
Very cool.
Right?
Very cool.
If it goes down 1%, I'm going to lose that $1,000. Now, every individual option has its own row. And what's going on behind the scenes when that interest rate rises or falls is computations of all these little options and what their row value is. So the sum of all those positions comes out to be this $1,000, right?
So from a cash flow perspective, I'm surprised that this is not used more often by retailers.
Yeah, here's the problem with retailers, I think, in terms of really needing to understand this. Um, Typically, retail folks put on positions that tend to be, I'm going to say 90 days and in. Okay, so 90 days down to zero. And most retailers probably trade in the zero DTEs to weeklies. So, changes in interest rates aren't dynamic, right? For their kind of inventory. This is more of a pro sort of Greek because they have positions that go out years potentially. And
Okay.
that's where it really becomes interesting, right?
Okay.
Let me make one point here too. So generally, when we talk about the risk-free interest rate, right, we're talking about a 3-month T-bill. Okay. So that's generally what we refer to as risk-free. Now, is anything really risk-free in this world? Technically not, but the best risk-free version that we have is a short-term treasury bill that's issued by the United States government. So that's the best you're going to get. So if the government doesn't default, neither is this bill, right? So that's what they typically use in the industry. Go ahead. You had a question.
So if there is, if people are worried about government default, does it become risky? In which case does Roe get affected?
Well, it can. Look at what affects the treasuries is inflation, right? Foreign sort of debt risk as well can affect it. So all kinds of things like that affect interest rates. But we're talking about the failure of the U.S. government here, right? So that's why they consider this to be risk-free, especially in 3 months. Probably not a lot going to happen in terms of failure in 3 months, right?
Okay.
And that's why they use that. And they sell these bills, these T-bills, subpar. So let's say that these T-bills have a face value of 100. So we would buy these at $99, let's say. So that 1% difference, it comes out to be 1%. That's what we're going to make in that example, right? Because in 3 months, my $99 is going to be worth 100. So I pay 99 today, and 3 months later, it's going to be worth 100. I make that $100, and that's my interest rate. That's my interest rate on this thing, and that's why they consider this risk-free, the number. Now, does that mean that if the Fed's raising interest rates to fight inflation, that you're definitely going to have an issue with your portfolio when that's going on? So understanding what we just went through with high inflation, Fed's trying to tap the brakes, raising interest rates. If you had positions as an options trader that were long dated, that were affected by those interest rate hikes, you're going to have either a great scenario, depending on what you have, or a bad scenario. Okay. So that is, go ahead. Sorry.
Which is important because I think in September, they're expecting a huge rate hike.
Again,
so
you have a crystal ball. Tell me about it. Tell me you have a
it's
crystal
called
ball.
Bard. No.
Oh, I love it.
No,
Yeah. So I mean,
I know they're all over the place.
And here's the problem, right? For the market making community, you're hedging, right? So you're always selling and buying things based on what the retail folks and the institutional folks want to do. So you always are trading. What happens if you get on the wrong side of row, right? You get in a position where if interest rates are in a rising climate and you have negative row on as a trader, right? And every time interest rates go up, you're losing that row value in your portfolio. And I gave an example of $1,000 on someone's position. I guarantee you row can be hundreds of thousands in these big market maker firms, right? In positions.
And just to clarify, so the relationship is if an investment is considered risky, there will be an inverse relationship with interest rates and with the risk-free rate. Is that correct?
Yeah. So no, not really. Here's why. It's not necessarily the investment itself, right? So it's the option portfolio, right? And it's
whole.
It's overall interest rate exposure. So when we trade options, we hedge things with stock too. So we come out with an aggregate stock position as market makers. We can be long stock or short stock based on what our option flow is, right? For our hedges. So if we're short a lot of stock, we earn interest on that short position. So we get paid for that, right? When we're short stock.
That's a
So
whole show in itself.
it is.
Right
It's
there.
and it's important to understand, and we'll just touch on it now. So if I'm short stock and I'm getting paid for that, and interest rates go higher, I'm going to get paid more. That's good, right? And short stock hedges what? Long calls and short puts, right? So naturally following, let's go back to the slide real quick. Oh, you know what? Yeah, let's go back real quick, and then we're going to go look at the markets in a second. So call row is a positive number, which means as interest rates rise, the option value of the call also rises. Okay. So it's proportional, directly proportional to, rising interest rates, calls go up in value, right? Conversely, put row is a negative number, which means as interest rates rise for puts, the price of a put goes lower. Okay.
Got it.
Now
Okay.
remember what I said. If you're long calls and short puts, right? Each one of those positions is long delta. Long a call is long delta. Short a put is long delta. Market makers hedge that by selling stock. Now
And
they're going to
refresh.
have aggregate short stock in our portfolio against this long call short put position, which could be all over the board, right? And you've got these dynamics happening. So row for us in that position is going to be a positive number on both sides of the equation.
Great.
Long call and short put, a negative times a negative. My short put is going to be a positive. So I'm getting long row with that position.
Okay.
Okay. Go ahead. Question. Sorry.
Well, just to refresh on what delta was.
Oh,
we're gonna do a whole recap tomorrow, but
yep.
Just to keep you.
The delta is the
How those work together.
Yeah. So when I get those deltas on, and for market makers, it's an equivalent share of stock. That's how we look at it.
Okay.
So if I have a 50 delta and I buy 10 of these, I'm going to have 500 deltas, 50 times 10 of these, right? So I got 500 deltas. And if I sell the 50 delta put, I have 500 more deltas. So now I got 1,000, 500 on the call side, 500 on the put side. To us, that 1,000 deltas, we have to hedge it. So we sell 1,000 shares of stock. Now we have 0 deltas in our inventory. So we've eliminated delta risk, right? So which tells you how much your option price changes over a $1 move in the underlying, right? So if I'm long both deltas and calls and puts and it moves up in this example, I'm going to get 1,000 deltas longer in that example, potentially.
Okay.
Right?
Okay.
And that all depends on gamma, which is, I'm just laying this stuff up. Oh my
God.
It all relates.
Tomorrow's going to be really neat because you'll bring it all the Greeks together.
We're going to bring them all together. Today's just row. So guess what time it is? Oh my God.
Market time.
It's time for the market. It's open 8:31. Okay. I haven't looked at this yet. Molly, what's the Dow Jones?
Oh, I still can't see it. Don't worry, we're working on a studio.
Yeah,
I'm still camping. I'm glamping.
Down 15. Down 15 nuggets. It's those are that's like nothing. We yawn over that one. Not much going on there at all. The NASDAQ is up a little bit, 25.18%. The S&P's my favorite, up a smidgen, 0.08%, only $3 or $4, right? So this is a super tepid opening. There's nothing going on here. Again,
and you
middle of the summer, not much news out there, nothing really stirring this market up, very light. Interestingly, VIX is up a little bit. Probably it could be a weekend effect, but I'm not going to comment on that yet. But still VIX is very low, pretty low, not very low, pretty low. So this is a sleeper. This is like going to your first dance recital. This is a sleeper.
Okay.
All right. So yeah, nothing going on here. This is the day when I call the golf course and say, hey, I'm leaving the pit. What do you got? What do you got available for me? Not much going on here.
Early lunch, Joe. All right.
We'll talk about how all these interact, and I'm going to show an example on TradeHawk. We can do that tomorrow as well.
Oh, fun. That'll be really fun.
Yeah, that'll be good. And I'll show you where row and all the deltas, gammas, and all the Greeks look on TradeHawk, and how I would look at it as a market maker and how a retail person won't look at it. Very much different.
And across all the Greeks, what's your biggest one? You were saying.
What's to me the most important? Two of them for me are, three of them, I guess. Delta is always important because market makers try to eliminate that to zero for the most part. Yeah. Right? When they have inventory, they want to try to get it as flat as possible because market maker edge is different. And we haven't talked about that either, but we're gonna. So market maker edge is much different. So that's why they eliminate their delta because of the type of edge they're getting between the bid and ask. And then my second one's probably theta, I guess. was always kind of important. I always wanted to be on the correct side of theta, and it wasn't always easy to get there, but
Yeah.
we kind of managed theta pretty well, I think.
Well, to get
So
Google on as your account, I'm
Google was
pretty sure you
nuts.
did that
Yes,
well.
right. Yep. So here, look at this one, Mal. Okay, you answer this.
Okay. Okay. Hold on. So it's hard for me to see. You can't see my setup, but nothing is visible to me.
You got to put your glasses on like I do.
Let's see.
How has Roe affected during the last few years when interest rates were super low and the Fed did not raise them for years? So that's a good question, actually. So
it would be portfolio dependent, correct?
Yeah, it does. But interest rates were stagnant for a long time until we started hitting the inflation skids, right? So Roe was not even discussed. People didn't even pay attention to it. You didn't really have to. It didn't matter because interest rates weren't doing anything. Now all of a sudden you have volatility in interest rates. What does that do? Now you have to start thinking about, hey, I'm in a rising interest rate environment. I have to be a little bit careful about having negative Roe in my portfolio, because if I do, it's gonna hurt as interest rates keep rising, right? Some shops, market maker shops in the old days, they would hedge Roe if they got too much of it in one direction. The bigger shops, they could hedge because they could trade bonds and all that stuff against it. So some of the smaller ones would not do that. We would just kind of try to manipulate our inventory a little bit to get as flat as we could. But I would say though that even in the trading days, that we as a firm, and we had some big positions and a lot of inventory, we were probably not great Roe traders either. We just kind of let it go for the most part and just wiggled. And we got hit in a rising interest rate environment or a falling one, depending on what our inventory was. So we occasionally get hit on those.
And so if
you were going to ask, sorry.
No, so if you had Roe taken into account, you could have avoided some of those losses.
Yeah, we could have. Sometimes it's hard to, because you just keep getting fed, spoon fed more inventory. But what do you do? What does a market maker do when I keep getting the same position on? I change my prices.
Yeah.
And I keep making, if you're going to hit me even further, I'm going to make it, you're going to pay more for it. So I keep changing my prices. So Roe works similarly for market makers than all the other options based on supply and demand. If I keep getting a Roe position, I'm going to keep, let's say they're buying calls for me and selling puts. I'm getting a Roe position when I take that on, right? I'm a negative Roe position. So I'm going to raise my calls and lower my puts. I'm going to keep doing that, right? Until I can keep getting better and better prices and hopefully hedge for what's coming probably in interest rates in that environment.
And is there any room for market manipulation? Can someone dump stocks to affect market maker prices?
Probably not.
Okay.
Probably not. Yeah, I'd say not. Not in this market. I'd say not.
So my big question is, if you have two interest rates, so you have the Fed rate, which is policy driven. If you have the risk-free rate, which is more market driven, you do not take into account at all the Fed rate, that they are affected somewhat.
Yeah, I think you take into account interest rates in general, because if they're all moving, if one's moving, they're all going to kind of be tugged, right? So it's going to define for you that interest rates are either moving up or moving down based on what they're doing at the Fed level. You're not going to have a disparity where you get 3-month interest rate, 3-month T-bills for 3%, and Fed is trading 20%. I mean, it's not going to happen, right?
So this might be a ridiculous question, but if the Fed rate occurs and if it's policy driven where risk-free is market driven, it might take a little lag there to reflect in the 3-month.
Yep. That could be. So there could be some lag.
Can you get an edge if you affect your Roe as the Fed rates get hiked?
It's hard to, because you know what? Roe's such a nebulous little Greek. You see my guy rowing in the boat? He's like a little innocent little guy in a boat.
We're trying to sell that guy. We're trying to sell him.
I know. He's such a cute little guy. And that's what Roe is. It's such a cute little Greek, and no one ever pays attention. It kind of hides in the corner. And interest rates really don't move that much, so no one ever pays attention to it until now. So I'd say don't wake up Roe. Just leave him alone. He'll be fine.
Well, okay, now I have a controversial question. Maybe not controversial, but yeah. So there is some nervousness about, government defaults, not that it would ever happen, but there is Financial Times quoted that Bitcoin may be the new, replacement for the 3-month T-bill. So do you feel that there is some question from people about how well, the dollar is doing, and if we've lost in 100 years, 99% of the value of our dollar, does
Did you say 100
there's
years?
in 100 years we've lost about 90% of
Oh,
the
I thought
value
you
of our
meant in the next 100 years. I'm like,
no,
I thought you
back
said
there.
50. I'm not going to be here.
No, right. So if there's a leak happening, if you want to call it a leak,
Yeah.
then how much confidence is risk free? Is it risk free?
Yeah. I mean, I'm as crazy as our policies are right now. That's my opinion. I still think America's going to pull itself up out.
Oh, for sure.
I
Oh
don't think
yeah,
we're going anywhere. I
we're
really
smart.
don't. I
Okay,
really don't. So we're gonna be still the
I agree with you.
go-to
By the way,
standard. Yeah, we're gonna
I
be the
agree with
go-to
you.
standard, I think, with all this stuff. Is Bitcoin gonna overtake it? We're gonna ask the Bitcoin experts on an upcoming show about that.
On
I
Wednesday.
don't think so for a while,
Okay.
but I could be wrong. I could be wrong. I'm not a big, Bitcoin fan yet, but I can
Yeah,
be
and
persuaded.
we'll have to look at, the Fed coming out with the CBDC, which is central bank digital
Mhm.
currency, and how that might affect the dollar. That would be interesting to look at
Right.
Roe in
Yep.
combination with that. That'll be interesting
Yep.
down the
Let's
road.
go to one more slide, if we can. So we're gonna go to not this slide, but this slide. So someone asked, can you give an example of how prices would change in the legs of a hedge position? So these are generic here, right? Prices, these options, I just made these up just as an example. So we have a call and a put, and we'll look at how this could work, right? So if I were, let's just go through the call first. So the call has a row of 25 cents. Okay, again, I made these numbers up. If interest rates increase by 1%, then that call should go up by the value of row, in this case, 25 cents. So $7 call becomes $7.25. Remember, calls go up with rising interest rates, puts go down. The $8 put, that $8 put becomes $7.65. Did I do the math right? Yeah, I did. And a 1% rise, right? Puts go down, they're negative row when interest rates go up. Okay. And when interest rates decrease, I did 2%. Okay. Calls go down. So in this case, 25 row, two interest rate points, right? 25
Multiple of
twice
2.
50, 650 becomes your call value. $8 put, interest rates decrease by 2%. I got to do a thumbs down. And then that goes up by 70 cents, 35 twice becomes 870. Now, to answer the person's question in the comments, think about if I were long this call and short this put and short stock, right? So if I'm long the call, short the put, and interest rates rise by 1%, my long call is now worth 725. I'm long it at 7. My short put that I'm short at 8 is now worth 765. I've made money here, right? I've made money in both of those. I made 25 cents on my call. I made 35 cents on my put. And I probably have short stock against this because these are both long delta positions that I said. I'm short the put, long the call. So I probably made money on my short stock because I'm getting more interest because interest rates have gone up on my short stock position. So I'm making 3 ways. Okay. Now, incidentally, if this were the same strikes out in time, the call where I'm making this number up, 50 delta call, I'm sorry, the 50 strike call, and the put with a 50 strike put in the same expiration, I'd have on what you call a reversal. Okay. And we'll talk about reversals and conversions in another time. But market makers get into these positions and they'd have big conversions, big reversals because they're hedged up and they're probably long a lot of calls, short a lot of puts, and then short a lot of stock. So interest rates rising is good for them on both of those fronts. Okay. So this is what happens to options. And imagine this in a whole portfolio. You've got longs and shorts all over the board. And when interest rates go up by that amount, that 1%, right, from 4 to 5%, let's say, this is happening hundreds and hundreds and hundreds of times in your position. And, the computer technology nowadays does this automatically. It's just, boom, spits it out, right? So you can always have a thumbnail what your row is in your inventory, especially as a market maker, right? Make sense,
And
Mal?
absolutely. And a question. So if you're really focused on row and row is based off of indirectly policy, you'd probably, and we're not going to talk about that here, but it'd be interesting to see, it's probably when the elections come up and who's in charge and pulling the levers of rates. It's probably it's a component, and they are
Yep.
probably proactively trying to affect their portfolios from a back end.
Yep.
Be interesting.
Yeah. No. Absolutely. So the other thing too is, it's because row wasn't very important in months past until inflation started spiking. Our system TradeHawk, we didn't even think about interest rate. I mean, obviously the model has interest rates in it, but for market makers, they'd want to kind of control that. We kind of hard coded it. Now we have to be like, oh my God, interest rates aren't 1% anymore; they're 5%. Right. So we have to account for that when you have option valuation and what your row is in a position. So you have to have a metric that allows you to change interest rates, right? So that's important too in your software to be able to change that interest rate as well. So you have good values of what these options are actually worth.
Which TradeHawk does.
TradeHawk does that. That's correct.
Which we will see tomorrow, which is really neat.
Yeah, interest rates are important nowadays because they're higher. We have to pay attention to it. I didn't realize, we got to go too. I see the time, but I didn't realize that money markets are paying like 5.25%. Right. So, again, I'm just a silly consumer. I'm like, oh, good. I think I have my savings account, this little bit of cash. I'm making 1%. I go, no, it's money markets are 5.25%. I'm like, that's insane. I couldn't believe it.
So you're saying that everyone needs to become a market maker. Everyone's in the
wrong.
Well,
I'm not saying that. You can't. No, you can't become a market maker anymore. You need a lot of money and a lot of technology. So it doesn't exist anymore.
I'll save that question.
Select few.
Yeah, that would be interesting to know about. I'll save that. I'm going to write that one down for another show. Thank you, Lex.
Well, Molly, not bad for a Monday.
I'm impressed.
After this, I'm gonna go and take my nap, man. Get the week off right. Good to see you. We'll talk something cool tomorrow, right?
All right. Yes, we're going to review the whole Greek island.
You got it. I love it. All right, good. That's the closing bell. See you tomorrow.
Bye, Lex.
Bye.